Imagine walking onto a trading floor and feeling the air literally get sucked out of the room, only to have it replaced just hours later by a wave of pure adrenaline. Well, that's exactly what global financial whiplash feels like. Panic, massive rebounds, and a looming tension beneath it all. Today, global markets experienced exactly that. It was a staggering sequence of events that left investors scrambling just to keep up. We saw sudden fear grip the most powerful financial institutions on the planet, followed by an explosive tech-driven euphoria, all while a deeply complex fundamental reality lurked right beneath the surface.
So, welcome to this explainer. I am so excited to guide you through the intricate, honestly almost cinematic sequence of events that completely rocked global markets today. The market roller coaster, from the Fed shock to the AI snapback. We're going to clearly map out the cause and effect here, step by step. By the end of this explainer, you won't just know what happened. You'll understand the precise mechanics of why it happened and what crucial signals you absolutely need to be watching for next.
Let's get right into it with Section 1, the Fed rate shock, and taking a look inside Chair Warsh's decision.
So, everything that unfolded across the globe today actually traces its origins back to a single room in Washington, D.C. The central bank made a move that absolutely stunned investors and analysts alike. But the exact rate range decision handed down today tells only half the story. The internal vote count reveals significant, undeniable dissent among the policymakers. The committee was completely split. This wasn't a confident consensus. This was a fractured decision made under immense pressure, and the markets instantly picked up on that underlying hesitation.
And beyond the numbers, it was really the human element that amplified the panic. Observers noted that Chair Warsh's tone during the press conference was uncharacteristically rattled. Actually, think about it. When the head of the Federal Reserve appears even slightly uncertain or maybe defensive about a divided committee, it pours absolute fuel on the fire of market uncertainty. The market thrives on predictability, right? And Chair Warsh accidentally broadcasted the exact opposite.
The moment that decision hit the wires, Wall Street reacted with an instantaneous, incredibly sharp drop. The Dow, the S&P, the Nasdaq, all violently repricing this new reality of a divided Fed and unexpected rate dynamics. For a brief window there, it genuinely looked like we were heading for a historic, catastrophic market close.
Which brings us to Section 2, Wall Street's AI rebound, also known as the megacap rescue.
Just as quickly as the bottom fell out, a completely different force grabbed the steering wheel. A staggering 15%. That was Microsoft's record single-day gain. In the midst of all that Fed-induced panic, billions of dollars suddenly came flooding back, and they were laser-focused on artificial intelligence. This wasn't some slow recovery, it was a violent snapback. Microsoft posted numbers that completely defied the gravity of the broader market sell-off, and it acted as this massive spark that ignited a rally and totally erased the morning's panic.
But here's the catch. This wasn't a broad market recovery. Not at all. AI megacaps drove a massive 85% of the snapback. They did all the heavy lifting to pull the entire market out of the red. The rest of the economy? Well, it was still reeling from the Fed shock, but the sheer gravity of AI hype just completely overpowered the tape. Now let's look at Section 3, Global Market Ripple Effects, and how the contagion spreads.
When the U.S. markets experience this kind of violent whiplash, those shockwaves travel incredibly fast. To really understand the global reaction, we have to look to the VIX. If you're not familiar, the VIX is Wall Street's primary fear gauge for 30-day volatility expectations. Simply put, when investors panic and hedge their bets, the VIX skyrockets.
And man, did it skyrocket today. But it didn't spike alone. It moved right in tandem with two other massive macroeconomic forces, bond yields and the U.S. dollar. When bond yields rise, borrowing gets a lot more expensive. And when the U.S. dollar spikes, it becomes incredibly painful for foreign countries and companies that hold debt in U.S. dollars. Together, these three forces act like a tightening vice on global financial conditions, pretty much completely choking off liquidity.
As Wall Street closed at 4 p.m. Eastern, that tightening vice was essentially passed across the world. By 9 a.m. in Japan, the Nikkei took a huge shit. At the exact same time, South Korea's Kospi was battered. 30 minutes later, Hong Kong's Seng and the Shanghai markets opened to immediate selling pressure, followed swiftly by India. That US AI rebound we just talked about? It didn't save them. They just felt the brute force of the Fed's shock and that stronger dollar.
Moving into Section 4, the AI CapEx undercurrent. Let's explore the tension right beneath the rally. So we've looked at the panic and we've looked at the tech euphoria. Now we really need to slow down and examine the sober reality underlying today's market action. To grasp this tension, we have to talk about CapEx, or capital expenditure. We're talking about physical data centers, millions of advanced microchips, and immense power grids. This is arguably the most expensive capital expenditure cycle in human history.
And this creates a really stark contrast. On one hand, we have this wild AI stock hype characterized by record high valuations and an absolute market reliance on just a few companies. But on the other hand, we have the reality of CapEx. Mega-cap companies are burning through tens of billions of dollars to build out this infrastructure for a return on investment that is, frankly, still largely uncertain. The market is pricing these stocks for absolute perfection, while the reality on the ground is massively expensive and completely unproven. Because of this, analysts are growing increasingly skeptical. They're looking at the astronomical build-out costs, the delayed profitability, and the severe pressure on profit margins. The big question haunting the markets today, even with Microsoft hitting a record gain, is pretty simple. Are these tech giants spending unsustainably without a clear path to profit? Because if that spending doesn't translate to immediate revenue, the very foundation of today's market rebound might just be built on sand.
Finally, Section 5. What to watch next, and how to navigate this uncertainty.
Moving forward, there are 3 critical upcoming catalysts that you absolutely need to monitor. Step 1 is the September Fed meeting. After today's internal dissent and Chair Warsh's rattled performance, every single word from the Fed in September is going to be scrutinized for weakness. Step 2, upcoming AI spending reports. We need to see the actual earnings from these megacaps to find out if their CapEx spending is finally generating real revenue. And Step 3, global geopolitical risks. With the US dollar being so strong and global markets like the Nikkei and Seng under pressure, any geopolitical spark could easily set off another wave of international volatility.
Which leaves us with this final pivotal question to consider. Can the sheer force of AI spending and innovation continue to put the entire global economy on its back and sustain the market? Or will the underlying reality of those high costs, combined with a highly fractured Federal Reserve in September, trigger a shock that even the tech titans can't reverse? The balance of the global economy has rarely been this fragile, and honestly, rarely this fascinating to watch. Keep your eyes on those 3 catalysts, and thanks so much for joining me for this explainer.